I've summed up my 10 takeaways and thoughts about this book in this video. I highly recommend you to read the original book of the author. Fundamental Analysis for Dummies, by Matthew Krantz, is a beginner's guide to understanding the basics of fundamental analysis. The book covers a range of topics, including how to read financial statements, calculate financial ratios, and evaluate a company's management team. The book starts by explaining what fundamental analysis is and why it is important. It then goes on to cover the various financial statements that are used in fundamental analysis, including the income statement, balance sheet. If you're new to the world of investing, you might be feeling a little overwhelmed. There are so many different investment strategies, and so much jargon to wade through. One approach that can help you cut through the noise and make informed investment decisions is fundamental analysis. But what is fundamental analysis, exactly? And how can you use it to evaluate stocks and other investment opportunities? That's where Fundamental Analysis for Dummies, by Matthew Krantz comes in. This book is a beginner's guide to fundamental analysis. It assumes no prior knowledge and breaks down the concepts and techniques in a clear, accessible way. The author's writing style is casual and approachable, which makes it easy to follow along even if you're not used to reading financial material. The book starts by defining fundamental analysis and explaining why it's important. It then covers the various financial statements that you'll encounter when analyzing a company, such as the income statement, balance sheet, and cash flow statement. If you're not familiar with these statements, don't worry, the book explains what they are and how to read them in plain English. Once you understand the basics of financial statements, the book moves on to financial ratios. These are calculations that help you compare different companies and assess their financial health. For example, you might use a ratio like price to earnings, P/E, to see how expensive a stock is relative to its earnings. The book explains how to calculate and interpret a range of financial ratios, so you can start using them in your own analysis. Another key component of fundamental analysis is evaluating a company's management team. After all, even a financially healthy company can struggle if it's poorly run. The book covers how to research a company's management team, including looking at their backgrounds and track records. The book also covers some of the limitations of fundamental analysis. For example, it can be difficult to predict future events that might impact a company's financials. However, the author is careful to point out that while fundamental analysis is not foolproof, it can still be a valuable tool for investors. Overall, Fundamental Analysis for Dummies is an excellent resource for anyone looking to learn about fundamental analysis. The author does a great job of breaking down complex concepts and making them accessible to beginners. If you're looking to build a solid foundation in investment analysis, this book is a great place to start. The first main point of Fundamental Analysis for Dummies is that fundamental analysis is an investment strategy that involves evaluating a company's financial health and management team to determine its intrinsic value. In other words, fundamental analysis is all about looking at the underlying fundamentals of a company to determine whether it's a good investment. This is different from other investment strategies like technical analysis, which focuses on chart patterns and market trends. When you use fundamental analysis, you're looking at things like the company's revenue, expenses, and profitability. You're also evaluating the company's assets, liabilities, and equity to get a sense of its financial health. And you're looking at the management team to evaluate their track record and experience. All of these factors can help you determine whether a company is undervalued or overvalued, and whether it's likely to be a good long-term investment. Of course, there's no guarantee that your analysis will be correct, but by doing your due diligence and carefully evaluating the fundamentals, you can increase your chances of making successful investments. The second main point of Fundamental Analysis for Dummies is that financial statements like the income statement, balance sheet, and cash flow statement are important components of fundamental analysis. Each of these financial statements provides a different view of a company's financial health. The income statement shows the company's revenues, expenses, and net income over a specific period of time, usually a quarter or a year. This can give you a sense of how profitable the company is and how its revenue is growing or not. The balance sheet, on the other hand, shows the company's assets, liabilities, and equity at a specific point in time. This can give you a sense of the company's financial health and how much debt it has relative to its assets. Finally, the cash flow statement shows how much cash is coming in and going out of the company. This can give you a sense of how the company is managing its cash flow and whether it has enough cash on hand to meet its obligations. To use these financial statements in your analysis, you need to know how to read them and understand the key metrics. For example, you might look at a company's net income on the income statement to evaluate its profitability, or look at its debt-to-equity ratio on the balance sheet to evaluate its financial health. Overall, the financial statements are a crucial component of fundamental analysis, and understanding how to read and interpret them is key to making informed investment decisions. The third main point of fundamental analysis for dummies is that to analyze a company's financial statements, you need to know how to read them and understand key metrics. Each financial statement contains a lot of information, and it can be overwhelming to know where to start. One approach is to focus on the most important metrics for your analysis. For example, if you're evaluating a company's profitability, you might focus on metrics like revenue, net income, and gross margin. To read the income statement, you start with the company's revenue, which is the total amount of money it brings in from sales. From there, you deduct expenses like cost of goods sold, research and development, and selling, general, and administrative expenses to get to the net income. The balance sheet is a little more complex, but it's still important to understand. It shows the company's assets like cash, inventory, and property, liabilities like debt and accounts payable, and equity like retained earnings. You can use these figures to calculate important ratios like the debt-to-equity ratio or the current ratio. Finally, the cash flow statement shows how much cash is coming in and going out of the company. It's important to understand the difference between cash flow from operations, which shows the cash generated by the company's core business activities, and cash flow from investing and financing activities, which show cash spent on things like buying new equipment or paying dividends. By understanding how to read and interpret these financial statements, you can get a better sense of a company's financial health and make more informed investment decisions. The fourth main point of fundamental analysis for dummies is that financial ratios like price to earnings, PE, and debt to equity, DE, can help you compare companies and evaluate their financial health. Financial ratios are calculations that compare different financial metrics to provide insights into a company's financial health. For example, the P/E ratio compares a company's stock price to its earnings per share. This can give you a sense of how expensive the stock is relative to its earnings. Generally, a higher P/E ratio means investors are willing to pay more for each dollar of earnings, which can indicate that the company is expected to grow in the future. The D/E ratio, on the other hand, compares a company's debt to its equity. A higher D/E ratio can indicate that a company is taking on a lot of debt, which can be risky. However, some companies may be able to handle higher levels of debt if they have steady cash flow and a strong balance sheet. There are many other financial ratios you can use to evaluate a company's financial health. For example, the price-to-sales (PES) ratio compares a company's stock price to its revenue per share. The return on equity (ROE) ratio compares a company's net income to its equity. And the current ratio compares a company's current assets to its current liabilities. By using financial ratios in your analysis, you can compare companies more easily and evaluate their financial health in a more standardized way. However, it's important to remember that financial ratios are just one tool in your analysis, and you should always consider other factors as well. The fifth main point of fundamental analysis for dummies is that you should also consider a company's management team and evaluate their track record and experience. A company's management team is responsible for making important strategic decisions, allocating resources, and driving growth. Therefore, it's important to evaluate the quality of a company's management team when considering an investment. One way to evaluate a management team is to look at their track record. Have they been successful in the past, either at this company or elsewhere? Have they made good decisions that have driven growth and increased profitability? You can also look at their experience and qualifications, such as their education or previous positions. Another important factor to consider is the company's corporate governance practices. Does the company have independent directors on its board, or is it dominated by insiders? Is there a clear separation of powers between the CEO and the chairman of the board? These factors can indicate how well the company is being managed and whether there are appropriate checks and balances in place. Overall, evaluating a company's management team is an important part of fundamental analysis. Even a financially healthy company can struggle if it's poorly run, so it's important to have confidence in the people who are making the decisions. The sixth main point of fundamental analysis for dummies is that analysts often use a combination of qualitative and quantitative analysis to make investment decisions. Quantitative analysis involves looking at hard data, such as financial statements and ratios, to evaluate a company's financial health. This type of analysis is important because it can give you a clear, objective view of a company's financials. However, qualitative analysis is also important because it can provide insights that you can't get from the numbers alone. For example, you might look at the competitive landscape to see how a company is positioned relative to its peers. You might also evaluate a company's brand and reputation, which can be important drivers of customer loyalty and growth. One example of how qualitative analysis can be used is in evaluating the management team. While you can look at their track record and experience quantitatively, you might also consider softer factors like their leadership style or their commitment to environmental, social, and governance (ESG) issues. By using both quantitative and qualitative analysis, you can get a more complete view of a company and make more informed investment decisions. However, it's important to remember that both types of analysis have limitations, and you should always consider multiple factors when making. And the seventh main point of fundamental analysis for dummies is that there are limitations to fundamental analysis, including the fact that it can be difficult to predict future events that might impact a company's financials. One of the biggest limitations of fundamental analysis is that it's based on historical data. While you can use financial statements and ratios to get a sense of a company's financial health, these metrics can only tell you about the past, not the future. This means that fundamental analysis can't predict sudden changes in the market or disruptive events that might impact a company's financials. Another limitation of fundamental analysis is that it can be time-consuming and difficult to do well. To perform a thorough analysis, you need to have a solid understanding of financial statements, ratios, and other metrics. You also need to be able to interpret the data in a way that's meaningful for your investment goals. Finally, fundamental analysis is just one approach to investing, and it may not be the best approach for every investor. For example, some investors may prefer a more passive approach, like index funds or ETFs, rather than trying to pick individual stocks. While fundamental analysis has its limitations, it's still a valuable tool for investors. By using a combination of quantitative and qualitative analysis, you can get a more complete view of a company and make more informed investment decisions. However, it's important to remember that no investment strategy is foolproof, and you should always consider your own risk tolerance and investment goals before making a decision. The eighth main point of fundamental analysis for dummies is that there are different approaches to fundamental analysis, including value investing and growth investing. Value investing is an approach that involves looking for undervalued companies that are trading below their intrinsic value. This approach is based on the idea that the market sometimes undervalues good companies due to short-term issues or external factors. Value investors look for companies with strong fundamentals, like steady cash flow and low debt, and invest in them with the expectation that the market will eventually recognize their true value. Growth investing, on the other hand, is an approach that focuses on companies with strong growth potential, even if they are trading at a premium. Growth investors look for companies that are expected to grow faster than the market average, and invest in them with the expectation that their growth will drive future returns. Both value investing and growth investing have their advantages and disadvantages. Value investing can be a good strategy for investors who are patient and willing to wait for the market to recognize a company's value. Growth investing can be a good strategy for investors who are comfortable taking on more risk in the hopes of achieving higher returns. Ultimately, the best approach to investing depends on your own risk tolerance and investment goals. Some investors may prefer a combination of value and growth strategies, while others may prefer a more passive approach, like index funds or ETFs. The important thing is to find an approach that works for you and stick with it. The ninth main point of fundamental analysis for dummies is that it's important to do your own research and not rely solely on the opinions of analysts or financial media. While financial media and analysts can provide valuable insights, they can also be biased or have their own agendas. Therefore, it's important to do your own research and form your own opinions. One way to do your own research is to read the company's financial statements and other publicly available information. You can also use online resources like financial news websites and social media to get a sense of what people are saying about the company. Another important step is to evaluate the company's competition. How does the company compare to its peers in terms of financial health, growth potential, and other factors? This can help you get a sense of the company's position in the market and whether it's likely to outperform or underperform. Finally, it's important to consider your own risk tolerance and investment goals. Every investor is different, and what works for one person may not work for another. By doing your own research and being honest with yourself about your risk tolerance and investment goals, you can make more informed investment decisions that are aligned with your values and priorities. In summary, while it's important to listen to experts and stay informed, it's equally important to do your own research and form your own opinions. This can help you make more informed investment decisions that are tailored to your individual needs and preferences. The 10th and final main point of fundamental analysis for dummies is that fundamental analysis is just one tool in your investment toolbox, and it's important to diversify your investments to minimize risk. Diversification involves spreading your investments across different asset classes, sectors, and geographies to reduce the risk of any single investment negatively impacting your portfolio. By diversifying, you can mitigate the risk of losses and potentially achieve better long-term returns. One way to diversify is to invest in a mix of stocks, bonds, and other assets. Within the stock portion of your portfolio, you can also diversify by investing in companies in different sectors and geographies. For example, you might invest in companies in the technology, healthcare, and financial sectors, and spread your investments across different regions like the United States, Europe, and Asia. Another important factor to consider is your own risk tolerance. While diversification can help reduce risk, it's important to balance that risk with your own investment goals and preferences. Some investors may prefer a more conservative approach, while others may be willing to take on more risk in the hopes of achieving higher returns. Overall, the key takeaway is that fundamental analysis is just one part of a successful investment strategy. By diversifying your investments and considering your own risk tolerance and investment goals, you can make more informed investment decisions that are tailored to your individual needs and preferences. Thank you for your interest in this book. Please leave your feedback on these thoughts in the comments below, or just put a like on this video. It will help me stay motivated and make more videos like this. In the description of this video, You may find links where you can purchase this book.